Coming back at you. All right. Creating this channel to give people value on money, how it works, how you can get out of debt. All right. This is really geared. I want to help moms. I'm on a freaking mission. All right. So let's dive into it. Let's talk about amortized interest, what it is, and why it's so bad. Okay. You don't want this type of debt. All right. So usually, amortized interest comes with loans, whether it be personal or business, car loans, right? Financing, auto loans, mortgages. If I spelled that right. Mortgages, and yeah, personal loan, business loan, car loans, mortgages. These are like the deadly debts that most Americans have that they never seem to be able to pay off in a short period. Student loans. Oh my God. This is a killer. Alright? Yeah. So, this is what most Americans are faced with when you're trying to build your life and make more money, okay, but you always seem like you can never get out because you got so much damn debt that you need to pay off, and you're thinking in your mind, oh, if I just pay more to it, that it's gonna solve the issue. And let me tell you why that's not going to work, okay, is if any one of these loans, let's do an example, let's say you've got $70,000 in student loan debt. Okay? Student loan, $70K. Let's say the interest anywhere probably from like 6 to 8%. Okay? If it's amortized, okay, key word is this 6% is not really 6%. It becomes more because what they do, what the banks and the institutions do and the credit unions is they front load this on the $70K. So your minimum payment on a student loan, who knows, was like $300 or anywhere 300 to 500 maybe, whatever it is. Minimum payment doesn't actually matter because what they're doing is, if let's just say the minimum payment is $300, of that $300 you've got more than half that goes straight towards interest, and then the other remainder is principal. Okay, this is a big reason why people are not able to get ahead, is because they don't realize where their money is going, right? So this student loan debt, okay, someone just graduated college, or 24 years old, whatever, and they got this immense amount of debt. They're going to try and get a job that at least matches that, right? Income, at least. Okay? And, they're going to try and do whatever they can to pay this off in time. But I want to just merely explain what amortized interest is, and then in my other videos I'm going to dive into how you actually can pay this off, right? Not pay down, but pay off using your own income, right? In a third of the time, right? Very important to understand this, ladies and gentlemen, all right? So anyways, amortized interest comes from these types of loans. They try to hit you with, they sell you on the low interest rate or whatever. Understand that the majority of the money gets front loaded. Keyword, front load. Right? On this debt, you try to, make these payments. You might even do something like a refinance. Okay? You try to refinance for a lower payment, whether it was on the mortgage, a loan, a car, student loan, whatever the case is, but you don't even realize that you just reset the clock on all the interest you've already been paying to the original debt. You went ahead and got like a debt consolidation company to come in and say, yeah, we're gonna, it's gonna be less. You're gonna pay less in interest. You end up really not. It just resets the clock for a longer duration period for a lower monthly payment. But even though you might have lowered your payment to like $200 or lower, again, all of the money gets front loaded in interest and nothing towards principal. You find yourself just paying down debt your whole entire life. So amortize interest, it's bad, okay? It's not flexible, okay? Interest is charged on the entire amount of the debt on an annual basis, right? So even though you're paying maybe $500 a month towards a debt, which is $6,000 a year, your balance is not gonna be $62,000 by any means. I mean 64. I'm sorry. Right? 70 minus $6,000. Yeah, it's not gonna be 64 at the end of the year. It's gonna be more than that actually. It's gonna be like you probably only killed like half. Right? And that's usually what it is. Like more than half goes towards interest in the beginning years, and very, very few goes towards principal. So what happens is in the next year, right, another 6 to 8% interest will get tacked on, and it just seems like you can never pay the damn thing off, right? Okay, so not flexible. Interest is front loaded in the beginning years, right? Never want to refinance. Okay, you really don't. I'm going to show you a more effective way. Okay, refinancing is for like real estate investors at a higher level where this makes sense. But when you're talking about personal debt, refinance does not make sense. Okay, and I'll show you why, and I'll explain in another video why that's so important to understand the difference between amortized and simple interest. All right, bringing value to you. Hope you enjoy that.